That's Jeremy Gardiner, Director at Investec Asset Management. Jeremy, let's pick up on our discussion just before we went to the break, and that is your impression of equities at current levels and what we can expect going into 2010. Are we looking cheap? Are we looking expensive? And I don't think cheap is a word that can be used at this point.
No, we were cheap in March. Now we're looking, equities looking a bit boring. They're neither cheap nor expensive. But I think for 2010, equities remain the place to be simply through lack of choice. There's not much else out there that's going to be exciting, and equity returns, although pedestrian, will still be better than cash. Cash a year ago was king. Poor cash has now unfortunately become trash because interest rates are so low and they're going to stay low for longer. So even though equity returns are not going to be what they were this year, they should still outperform anything else.
And in the fixed interest environment, corporate bonds are the way to go?
Corporate bonds looking attractive, yeah.
Gold. Where do you think gold is going? And again, let's pull into this discussion the disinflation versus inflation argument.
Well, you see, the one thing that really excites gold is the possibility of a global financial collapse. And the closest it's been to that was last year, and still gold only went up to about 1,000. What's been driving gold this year? The dollar weakness has been driving gold, and the possibility of inflation out of control as a result of too much money being pumped into the system. We believe that the dollar depreciation is probably almost done, and we think that inflation is going to be reasonably under control, moderate inflation going forward. So you would think that that would put a halt on gold's movements. But actually gold is rising now because it's quite a good hedge against something going wrong. And it's also the only currency that central banks can't print. So I think people are buying it from that perspective as well.
So all in all, although forces are starting to work against gold, you are generally positive on the momentum that we will continue to see on the gold price front, given the fact that, as you say, it is the only currency that central banks cannot print.
Yeah, the reasons have switched to buying it away from inflation, away from dollar collapse. Now, as I say, more towards a hedge against something possibly going wrong. And also central banks devaluing the value of currencies. So as long as those fears persist, gold will still be okay.
Jeremy, thanks very much. Appreciate your time this afternoon. Have a good festive season, and we'll touch base again in the new year right here on Closing Bell. Standing by now is Brent David, fixed income trading at Absa Capital. Brent, let's start with the CPI story out today, coming in at 5.8%. Obviously, it is better than expected. We were expecting to touch the upper limit of that inflation band, the 3 to 6% inflation band set by the South African Reserve Bank. How has the market reacted?
Hi there, Bronwyn. Yes, you're 100% right. It is. We saw CPI printed at 5.8%. Market expectations were around about 5.9%, and this is the second time that we've been within the band for close on 3 years now. So, you know, market expectations and reactions was relatively muted. I think that going into year end, a lot of people have squared off their books, and really the market was looking for a big number either way, to surprise on the downside or to surprise on the upside, for there to be any significant reaction in the market. So on the back of a 5.8% print with expectations of 5.9%, it was relatively muted. And then with the auction today, we saw relatively strong bids coming in the auction, so the market rallied on the back of that. But toward the close, we saw some sell-off in the bonds on the back of the weakness that we saw in the currency. So all in all, a relatively muted reaction from the market on the CPI print.
Having just been through some commentary from Investec Asset Management and having chatted to Jeremy Gardiner, I see they see inflation holding in that target band well into 2010, in fact, into the middle of 2010. Would you concur with that view?
Look, Bronwyn, I think that our own in-house expectations is for inflation to be under pressure to the top side. There are a number of different views out there, and certainly from a trading desk perspective, I still believe that the risks are to the downside in the short term. Obviously, you can see a pretty rapid turnaround in the global economy, and from a growth front, if we do continue to see growth surprising to the top side, particularly from the likes of the US and Euroland, you could potentially see this filtering through into sticky inflation to the top side. So certainly from a short-term perspective, I think that the risks are still to the downside. It certainly is the momentum. But if you do see a turnaround in growth, like I said, going into Q1 and Q2 of next year, it is going to be difficult for inflation to collapse even further.
In the fixed interest environment, Jeremy Gardiner pointing to the fact that corporate bonds are looking the most attractive. Is this where we're going to see all the action?
Well, no, I actually disagree, to be honest. I think that if you take a look from a global perspective, South African fixed income is one of the highest yielding in the world, and particularly in our time zone, whereas typically we used to be one of the lower yielders compared to the likes of Turkey, Hungary, Russia, etc., etc. Those countries have cut interest rates so aggressively that their fixed income markets have rallied particularly aggressively. So we're in an environment now where a lot of people have actually gone the other way around, where international investors have been underweight in South African bonds, and macro accounts and hedge funds have been paying interest rate swaps. So positioning is particularly bad. A lot of people are underweight in South African bonds, and in an environment now where our bonds are yielding quite high, you'll find a lot of demand for our bonds. So I think at the moment there will be growing activity in our government bond market.
And just very quickly, what is the bond market saying about the chances of an interest rate cut come January and the Monetary Policy Committee meeting on the local front?
Look, I think that the market expectations are still that there's going to be an outside chance that they do have an interest rate cut. The short-dated interest rate FRAs are not necessarily pricing very much. I'd say it's pricing on 15 to 20% chance of a 50 basis point rate cut. But certainly going into the new year, the market's going to be looking for a lot of commentary coming out of the central bank and National Treasury to see if there's any discussions further along the lines in terms of changing mandates, etc., etc. There's been a lot of noise around that, and the market will be looking, watching the news wires quite closely for further news along those lines. However, the market still does believe that there is a slight chance that you do see a further interest rate cut, and like I said, that's pricing in for the end of January of 2010. It's only about 20% right now.
Brent, thanks very much for your time. This is my last closing bell before we hit the new year, and I'm in a very festive mood, so I've been wishing everybody a very good festive season. Same to you. Thanks very much for joining us on the desk this afternoon.